Mr. Pratik Gupta, CEO at co-head of Kotak Institutional Equities, joining us on the board, and lots to talk about. Pratik, you have the global news flow coming in. You also have the wrap on the earnings season that we're very close to now. It's already been a wrap on the Nifty 50 companies. Pratik, let's start by talking about how the earnings season has been. Your take on the earnings season so far, because now that we've finished with all of the Nifty 50 earnings and the last three particularly being quite strong. What's your take on how the earnings season has been so far? Any unexpected misses or surprises that you've spotted?
As far as the earnings season is concerned, it's been broadly in line with somewhat muted expectations ahead of the earnings season. So, for example, for the Nifty as a whole, we were expecting about 5% earnings growth. It's come in about 6.5%, 7% for the June quarter. But I think more importantly has been the commentary and the guidance, which actually has been somewhat weaker than expected, and the continuing weakness in the economy. So, for example, for the Nifty as a whole, for FY26, we were projecting about, at Kotak, we cover about 300 companies. So for the broader universe, and more importantly for the Nifty 50, before the start of the June quarter earnings season, we were projecting about 12% earnings growth in FY26. That estimate has now come down to 10%, and our analysts still see further downside risks if things don't pick up in the next 1 or 2 quarters. So the earnings season has been sort of okay, but and there are a lot of hopes now on the second half post-monsoon recovery, the festive season demand, the impact of the RBI rate cuts, and obviously most importantly is expectations that the Trump tariffs will somehow, they'll come down to more reasonable levels next week or later this month. So that's really the expectation. If those things don't pan out, then I think as far as earnings are concerned, we could actually be in for some negative surprises going forward.
Interesting. So in this kind of, Pratik, flux of all the news flow, all question marks about what the festive season is going to do, what the government intends to do after the big fillip that we've already seen from the RBI in the previous policy with that 50 bips cut, and of course the big question mark on tariffs. How do you think investors should be positioning themselves right now? Because at best you only have very tactical short-term visibility.
You're right, which is why we are recommending, somewhat of a cautious stance. We don't think this is an environment where you need to take on risks. So a couple of broad themes we would recommend. One, look at domestic plays rather than export plays. Second, look at quality versus value, momentum, cyclical kind of plays. And third is, and therefore as a corollary of the second one, I look at large caps versus the small and mid caps. They tend to weather an economic slowdown much better. What's clear is we are going through a slow growth patch, and this may persist for some more time. And who knows, it may get worse if the tariff headwinds don't abate. So we are in for a tough economic environment. We don't see signs of a very strong domestic economic recovery, at least not in the short term. We haven't seen any sort of government action as such coming through in terms of reforms. So until then, therefore, you have to be somewhat cautious. So therefore, stick to domestic plays, stay away from IT services, for example, where even before the US tariff threat, we were concerned about high valuations. Second, the weakness in discretionary IT spending, and then you've got the AI risk coming through. We had ChatGPT 5 being released last week, so just shows overall how things are moving in that direction. So generally, be cautious, stay away from cyclical or rather high beta plays. Be defensive, and don't try and be a hero in this environment. That's sort of the broad advice.
Hi Pratik, this is Shrishti also joining in. So like you have been mentioning that you have made some tweaks in your earnings estimate, which is now down to 10% versus 12% earlier. But help us understand which sectors are you spotting that may outperform this growth number? Because of late we have seen some sectors and some companies rather talking about the double-digit growth. Case in point being hospitals, case in point being the EMS companies and select pharma companies as well. But what's your sense that sectorally, which companies or sectors can go ahead and outperform the consensus growth?
So, firstly, let me perhaps begin with sectors which are likely to underperform, and that's usually, typically this year, it's going to be the IT services companies, the consumer sector, where volume growth is still low single digit, revenue growth and maybe high single digits. And even the banks this year are likely to not show very strong earnings, both a combination of lower NIMs as well as higher credit costs. So these are the large sectors which will likely underperform. When it comes to outperformance, as you rightly pointed out, some of the sectors you mentioned, we also like them. Hospitals is definitely a space we like. This is a sector which is also somewhat unimpacted by the tariff situation or global slowdown. So that's a secular growth story. Valuations are a bit on the toppish side, but nonetheless, growth is very, very strong. So we like the hospital space. Hotels, airlines, this is another sector. These are other sectors that we like. Again, more domestic focused, less impacted by what's going on globally or with tariffs. Telecom, frankly, there's just one play there, Bharti. So we like that one as well. We also like some of the leading NBFCs where we think the decline in funding costs should basically help these guys, and the credit cost impact may not be as much. So we like some of the NBFCs and private banks. We don't think they will outperform from an earnings perspective, but valuations have come off. A lot of these stocks have come down sharply, and in the context of the overall market, these stocks are looking relatively more attractive. The Nifty is trading at 21 times. So you have to look for not just where earnings are very strong, which is, for example, the EMS companies you pointed out. They have very strong earnings growth, but valuations are off the charts. These stocks are trading at 60 to 80 times 1 year forward earnings. So we like the businesses, but not the stocks. Which is why we'd rather be in businesses which are not doing as well, like the banks, for example, but where valuations are a lot more attractive.
So that's the take on what's looking good and where are you seeing conviction right now. But Pratik, also give us a sense on some of these new age consumption companies, if we could call those that, because we've seen numbers coming in from Nykaa, Honasa Consumer. So you have categories like BPC, fashion, all of them have been doing better compared to the traditional staples category that we've seen. What do you think lies ahead for overall consumption, given that we also have the festive and wedding season coming ahead? Where are you seeing this end or this pocket of consumption, the new age consumption names heading from here?
So firstly, on the broader consumption space, there's no doubt that we will likely see a better second half of this year. Typically, it's a seasonal uptake. You have the festive season, and this year the monsoon has been good, so rural demand should be good. And so that's there. But I think the main question to ask is how much of that is priced in. So, and that's the problem with a lot of these consumer companies, which are trading from anywhere between 40 times to 60 times 1 year forward earnings. So, which is why we would rather play companies where sustainably on a longer term basis, apart from the cyclical second half seasonal uptick, you will see continued sustainable growth in the years ahead. And that usually is these consumer tech companies like some of the ones you mentioned, where they're gaining market share, they're pulling further away from some of the weaker competitors in this slow economic environment. So again, what we are saying is look for category leaders, even within the consumer sector. Look at these consumer tech companies, which are category leaders. Some of the names you mentioned, Nykaa, Honasa, etc. They are pulling further away from some of the weaker competitors. But again, the next 1 or 2 quarters are still going to be somewhat tough. Valuations are elevated. So don't expect any dramatic returns from their stocks in the near term. But on a 3 to 5 year basis, if you're willing to wait that long, these are the stocks we would like.
Pratik, I'm wondering, I mean, since, everything is so tactical and myopic in nature right now, what about earnings from cement and chemicals? You think there were any positive surprises in there?
Yeah, there have been some, cement in particular has done somewhat better than expected. But again, there's a lot of capacity addition coming through. Every major cement company is increasing capacity by, say, 6 to 8% per annum. Demand is more or less keeping pace. And here, the other problem is the real estate sector seems to be showing signs of slowing down. So that's a bit of a worrying sign. But on the positive side, you have the second half government capex, which is likely to kick in post September, October. So that should result in a fresh lease of life. Again, over here, valuations, most cement stocks are trading at very, very expensive valuations. So we have generally, for the last 6 to 9 months, been somewhat cautious on cement stocks. Chemicals, there is the other problem, which is competition from China, the tariff-related uncertainty. So chemicals as a space, we've been extremely negative on. Not just now, but for the last 2 years, and that call has largely worked out. And even now, most of these stocks are trading at anywhere between 25 to 40 times. There's a lot of capex going through. The demand visibility is quite poor, and there is the uncertainty about the competition from China. So chemicals we would definitely avoid. Cement is a bit more cyclical, and you have to sort of time your purchases. This is a commodity business. You go through periods of extreme undervaluation, sorry, extreme weakness in demand, and that's when you get a little bit of undervaluation, and that's when you sort of jump into these stocks, but not at this point in time. Right now, we would stay away from both these sectors.
Okay, makes sense. Pratik, good to have you on the show. Thanks for your time today.
Thank you.